Welcome to today's small business training session, and today we're going to continue to think about how we grow the business, how we make the business bigger. So first of all, let's think about what we were talking about last week. We spent some time last week thinking about the different ways that we could expand our businesses, and one of the ways was to apply for a business loan in order to perhaps purchase equipment. So in thinking about a business loan, we were considering what a loan company would need to know about us and about our business in order to be confident to lend us the money, so that they were sure that they could get their money back, that we were able to pay it back out of the business. And then we went on to think about our business proposal, to start thinking about our business proposal. And the first step is to describe how well our business is doing. And we talked about filling in a balance sheet, creating a balance sheet, which is based on actual figures, which will describe then just how the business is going. So this will be a useful thing for anybody to look at who might be interested in making a loan to you to help you expand. One of the things that's important is to remember that if you want a business loan, you need to be able to show, you need to be able to demonstrate that you can pay back the money that you borrow, and also you need to be sure when you can pay that money back. That's important not only for the person who is lending you the money, but also for yourself as well, and for the success of your business. So last week was all about describing the current position, the current situation of your business. How's your business doing right now? And then this week we're going to carry on thinking about the business proposal, but we're going to think about what's going to happen in the future, and how an expansion is going to affect the business, how it's going to benefit the business. And one way that we can do that is by calculating our return of investment, which I'll explain shortly. So having established what the business looks like now, having described the business with an actual balance sheet, what we need to do now is think about what the business will look like when you've made the improvements. So in other words, if you have a loan, if you're successful in getting a loan, and you use the loan to buy some perhaps new equipment to make your business better, what's the business going to look like after you've done that, once you've bought the new equipment, for example? So we're going to think of a way of describing what we expect the business to look like. And this is going to be very familiar because it's just the same really as our balance sheets that we've done before. But this time, rather than putting down figures which are actual figures based on the current position, we're going to think what our figures are expected to be once we've made the business improvements. So in other words, this is going to be the expected balance sheet. And by the time we finish today's lesson, you will have two balance sheets for your business. You'll have an actual balance sheet which describes how you're doing right now, and you'll have an expected balance sheet which describes how your business will look once you have expanded it, once you have spent the money from a business loan, for example, to improve your business. So now let's focus on the expected balance sheet. And this is getting quite boring really, because this is exactly the same as your current balance sheet, your actual balance sheet, but just with different figures on it. So in other words, if you think about the balance sheet, what we need to show on the balance sheet is what you expect your weekly income to be once you've made the business improvements, what you expect your weekly expenses to be again, after you've made the improvements, what you expect your weekly long-term savings, in other words, how much money you're putting aside every week for major purchases and emergencies, that sort of thing. And also, what kind of a personal weekly wage are you expecting to take out of the business once you've expanded it? Now, I think it's easier to understand this through an example. So let's think of a business which is a juice shop for somebody selling juice. So buying fruit and making juices to sell from the raw fruit that is being bought. So if we look at the balance sheet for the juice shop, our first line there is income. So if we read through the example, so the price of 1 cup of juice is 20 Kenyan shillings in this case, but it doesn't matter what currency we're using. And this business estimates selling 30 cups a day of juice, and this person expects to work 6 days a week. So the total weekly income is 20 shillings times 30 cups per day times 6 days a week, which gives a total weekly income of 3,600. Now, if we think about all the expenditure, all the money that goes out of the business or is saved every week, first of all, we have running costs, so things like electricity for the juicing machine, water, fruit, mangoes in this case. So we think those are going to be 1,585 per week. If we think about how much money this business puts into savings for long-term costs, for things like equipment and emergencies in the future, this business is putting aside 1,015 shillings. And then the person who's running this business takes a weekly wage out of the business as well. So this person takes 1,000 shillings as a weekly wage. So the total of all of the expenditure is 3,600. And you'll notice that that balances with the income. So the same amount of income, the same amount of money is going into the business as is coming out of the business. So this is a successful business. But I'm sure, like you, this person is keen to improve things, is ambitious, and wants to increase the business. So it's reckoned that a loan of 15,000 shillings will enable this business owner to buy a fridge. And because this business owner can then sell chilled fruit juice drinks instead of kind of room temperature drinks, it's expected that the sales of juice will increase by 50%. So in other words, the income from the selling of chilled fruit juice rather than room temperature fruit juice will increase from 3,600 shillings income to 5,004 shillings per week. So now what we need to do is to add these figures onto our balance sheet, onto our expected balance sheet. Now, the first thing you will notice is that the expected balance sheet is very similar to the actual balance sheet. So let's go through this now. I've highlighted in yellow the things that have changed. So first of all, the income side, the line, we have said that the amount of juice that's being sold, cups of juice being sold, will increase by 50%. So in other words, the new income is 5,400 shillings per week. So that's good news. That's more money coming into the business. However, as well as more money coming into the business, there is more money going out of the business, there's more expenditure. So although we've increased the number of cups of juice that we're selling, we've also increased our running costs because we need more electricity, we need more water, and in this case we need more mangoes. And so there is an increased cost associated with this business now. So the cost has risen to 2,400 Kenyan shillings. In this scenario, we are still going to put the same amount of money away for long-term costs, for savings. So that's going to stay at 1,015 shillings. But we have a new line to add into our balance sheet because we have to account for paying back the loan of 15,000 shillings. So what we have agreed in this case with the person who has given us the loan is that we will pay the loan back at a rate of 985 shillings every week. So that needs to be accommodated in our expected balance sheet, and you can see that on the screen. At the moment, although we are increasing the business, we're not going to increase the amount of personal wage that we take out of the business. We're going to keep that at 1,000 shillings. So that hasn't changed. And therefore you will see that the total expenditure of all of those things added up comes to 5,400 Kenyan shillings. And again, as with any balance sheet, it's really important that our income is exactly the same as our expenditure. Our total income is the same as our total expenditure at 5,400 shillings in this case. And so the business is going to continue to be successful. So let's focus now on the business loan. So in this example, we said that the loan was for 15,000 shillings and that we could afford to pay it back. We're planning to pay the loan back at a rate of 985 shillings per week. So the next question is, how long, with those weekly payments of 985 shillings, how long will it take to pay back the loan? And some very simple arithmetic. 15,000 shillings divided by 985 shillings, which is the amount we're paying back every week, means that we will be able to pay the loan back in 16 weeks. So we can think of that as the return on investment. So in other words, the return on investment in this case is 16 weeks. So after 16 weeks, you would have paid off the loan and your business will be more profitable because the money that you were spending in paying the loan back, you can now invest into your business. So it feels like it's time for yet another balance sheet. So this is our third balance sheet. First of all, we had our actual balance sheet to tell us how the business is doing at the moment. Then we had our expected balance sheet, which described how we expected the business to be doing when we were paying back the loan. And then our third balance sheet, which we're going to look at now, is our final balance sheet. So this is after we have paid the loan back. So we've completely paid off the loan, and then the money that we were spending on paying for the loan, we can plough back into the business. So let's have a look at this balance sheet now. So our income still is 5,400 shillings. Because with our new fridge that we've bought, we were able to sell more cups of juice per day. Our weekly running costs are the same as they were when we were paying off the loan, because the extra electricity includes what we have to pay for the fridge, and it includes all the extra mangoes that we need to buy. Now, if I jump down 2 lines, our weekly loan repayment is actually 0 now because we've paid the loan off. And that means we have more money to spend on other things. So in this balance sheet, what we've done is we've increased our weekly savings for long-term costs. That's for equipment or emergencies. It was 1,015 shillings, and we've increased that to 1,500 shillings. So this means in the future, your business will be able to save more money more quickly, and you'll be able to afford more equipment and be in a better position in case of emergencies in the future. The other very nice thing to note on this balance sheet is that once you've paid the loan off, you can also increase your personal wage. So you can reward yourself with more money for yourself out of the business. And in this case, on this balance sheet, our weekly personal wage has increased to 1,500 shillings, whereas before it was 1,000 shillings. So this is good news. Not only can you pay yourself more money and earn more money from your business as a result of this investment, but also you can put more money into savings for the business as well, which will help you make the business stronger. And it may be actually because you are increasing your savings, you don't need any business loans in the future because you can save up the money yourself when you need new equipment. So what have we learned? So this week we've learned how we can use actual and expected balance sheets to support your business proposals and your business plan and your loan request. And we've learned how this will help you to demonstrate how healthy, how successful your business currently is. So that's important if you want to get a loan, that the person you are getting a loan from understands that it's a good risk, that you are running a successful business already. And also we've learned how doing our actual and expected balance sheets helps us to estimate our return on investment, and that in turn helps us calculate how long it would take us to be able to pay back the business loan. So where are we going next? Just thinking about last week and this week again. So last week we covered actual balance sheets. That describes your current business, the current state of play. And then this week we've looked at estimated balance sheets and also final balance sheets. And also we looked at the return of investment this week too. So next week what we're going to do is put it all together into a business proposal. So you'll have a document that will both describe where your business is now, where you want to go with the business, and should you want to take out a loan, then you have a good document in order to help you to do that. So as always, at this time in the lesson, it's time for a couple of exercises. So first of all, as a group, what I would like you to do is work out the return on investment in the following example. So you'll see there an expected balance sheet. You have a loan of 20,000 Kenyan shillings, and what I want you to do is calculate what the return of investment is. So in other words, calculate how long it will take you to pay back the loan. And the second exercise is for you to do as individuals, and potentially you can do this based on your own businesses. What I'd like you to think about is how big a loan would help you expand. So how much money would you want to borrow? And then write down your expected balance sheet. So create an expected balance sheet, which would include the weekly loan repayments based on how much you want to borrow. Remember that your balance sheet should include all of your income as well as all of your expenditure. And then once you've created your balance sheet, calculate the return on investment. In other words, calculate how long it will take you to pay back the loan, how much you can afford to pay every week from your business. And then, as usual, please post the answers on the WhatsApp group. Now, to help you with this, I've also suggested that you use the template that we've been using in this course. So that will help make it clear, and if everybody has the same sort of headings, it means we can compare notes more easily with each other. So if you use the template that you see on the screen now in answering the questions for exercise 2, that'd be really great. Remember again, can't stress this enough, that everything is done, all the numbers are on a weekly basis, but also remember that all of your total income must equal the total expenditure. So in other words, the amount of money coming into the business must be the same as the total money going out of the business on a weekly basis. I'm sure you'll get on great with this, so have fun in doing it, and I'll see you next week.